Hello, everybody. Welcome to Monday. The S&P 500 was down 0.1% today. It was down a little bit more earlier on in the day, kind of came up a little bit towards the end, but really, I think just waiting for tomorrow's CPI report. We've seen this a couple times now, waiting for all these different inflation reports. The last CPI report kind of got people on edge a bit, and that's why these things have kind of changed. Just because it was a bit hotter than expected. Month over month was hotter, so we'll see what happens this time. It comes out tomorrow. We'll know pretty soon here. We don't have to wait very long, which is nice. And again, just to remind you, CPI is not the measure that the Fed really focuses on, although it is the last data point they're going to get from a big, inflation report before they meet again for their next meeting and where they decide what to do here. Um, and the expectation at the moment is that they're not going to do anything. So that seems to be still intact, probably no matter what happens tomorrow. But I will say, looking at the market, it's pretty stretched out. There's several different indicators. You're starting to see the rate of change come down a bit, just kind of is slowing down because it's so stretched out. Again, using my analogy of rubber band, you grab the rubber band, you can go, but it gets harder and harder to stretch it the farther you get. So it's pretty much what's happening right now. The RSI index, which is a major stretch index that I use, is up at 75 right now. That's quite high. Above 70 is high. So 75, it can get higher. You can get a bigger jump. There's all kinds of things that can happen. But it's just, I think the markets, really needs to kind of settle in for a little bit here. In order to make a sustained run, you got to have some wait period, some drop back, some sideways motion, something. So, just continuing to go straight up just means that probably going to have a bigger snapback when it comes down. And unfortunately, sometimes that can then get its own momentum and start to come down. So I'd rather see it, take a break here. So we'll see, what happens altogether. It's not a bad time of the year for the market. A lot of people putting money into their IRAs and things like that that kind of, funnel money, into the market too. But nonetheless, still, hanging in there. Not down much today at all, actually. Last week, there's one thing I wanted to mention that happened kind of after the show, but the S&P 500 was down for the week. That's the first time in quite a while. But the equal weight S&P 500 was still up and actually set another record. It doesn't have the same rate of return as the S&P does, but it is starting to show some strength where the S&P is not. So what that means is the S&P is capital weighted index. It means that it's the big stocks are driving it. So the bigger their capitalization size, the more impact they have on that index. An equal weight index treats all the companies the same and weights them all identically. And when you look at an equal weight index and it starts to do well, it just means things are starting to broaden. And they're starting to move out into other types of stocks away from the big seven that everybody keeps talking about. Saw another headline today saying that only two of the big seven are actually ahead of the S&P 500 so far this year. So that's not a bad sign. Again, normal scenario is big, stable companies start off the rally, then it starts to spread. And if it continues to go and go and go, it'll start to spread into all kinds of different areas before, we have some setback and kind of unwinding of some of that. So I am, pleased to see the equal weight index starting to do well. I don't know if it's time to jump on that type of index or not yet. It hasn't showed quite enough strength, but still it's a great measure to watch. So anyway, that's what's happening now. I look forward to seeing you tomorrow. Thank you.